All right, welcome to Emerge Stronger. I would like to introduce you to Mr. Eddie Tubin from the FSC First, and we'll get started very shortly. Eddie?
Good morning. Good morning. Thank you so much. Happy Friday, everyone. October the 9th. Welcome to session 2 of Emerge Stronger, Loan Compliance and Reporting. I'm your host, Eddie Tubin, Chief Lending Officer from FSC First, joined by my manager, Dawn Medley, Senior Vice President, Finance Programs, FSC First, both in lovely Prince George's County. The goal of Emerge Stronger is for small business recovery and resilience. It's to increase the post-COVID-19 economic recovery odds of Prince George's County small businesses and our business ecosystem. It offers programs that allow small businesses to remain open for business and thrive, create and maintain healthy business operations and finances, pivot their business models based on industry best practices, address employee and customer needs, and prepare them for emerging crises. Please thank our government officials for this, and we'll talk about our sponsors in a little bit. We are recording this session. If you do not want to be recorded, please exit now. Some housekeeping rules for us to get started with. Sounds, please mute your microphones and videos. They're disabled during the webinar. We ask you to use the Q&A section as opposed to the chat section for questions, and Dawn and I will respond appropriately. The presentation and the recording of today's webinar will be available on emergestrongerpgc.com/session-library, and there are others on there. Our first successful loan packaging strategies, which was held last week, is available there now. Prince George's County partnership between the Economic Development Corporation, FSC First, the Bowie BIC, we've all partnered to provide county businesses with Emerge Stronger, the ultimate resource for successful business operation and acceleration in the county and beyond, especially during these very, very difficult times. Please learn more about these organizations and what they bring to Emerge Stronger by visiting our websites. I'm very pleased to introduce my manager, Dawn Medley. She is the Senior Vice President and EDI Fund Manager of FSC First, with more than 25 years of commercial lending experience, including complex credit analysis, underwriting, and loan closing. She provides us with the day-to-day management and staff support to the origination, lending, closing, portfolio, and asset management activities, along with program and resource development. Dawn also assists the President and CEO, who are very happy to have here today with us as a guest, Shelley Gross-Wade, with activities regarding revenue forecasting from lending activities, strategic planning, and she serves as the EDI Fund Manager, which essentially caused her to work 7 days a week for the past many, many months as we distributed a tremendous amount of funds to local small businesses to help support the stability of the small businesses and get us through this period of COVID-19. I'm the Chief Lending Officer, reporting directly to Dawn. I have 30 years experience in the market. I'm very, very fortunate to be at FSC First. It's a band of 12 professionals in the financial services community who are dedicated as lenders with a heart to really help small businesses in our county find ways to be able to create businesses and create jobs. Beside being an expert in small business administration lending, I am a guest speaker most recently on Business for Impact, Conscientious Capitalism, where I speak at Johns Hopkins Carey Business School, the Georgetown University's McDonough School of Business, and have been a frequent speaker at Catholic University's Capital Access Expo. And you'll see that Dawn and I are going to provide to you information regarding our connections and contacts later on today. So what have Dawn and I been doing since the beginning of the year, along with Shelley, and why are we slightly different in terms of other lenders that might be providing information today? Where most lending institutions shut down at COVID-19 and basically stopped lending for a while because the waters were uncharted, we received and reviewed 916 applications for the fund. 596 applications were approved. $20,190,500 in grants were awarded to help support small business. And as of the last time this was drafted, 455 of the approvals were already wired. That number's changed now, but we estimate we saved 3,090 jobs. And I think what's important to all of you listening today, what really makes a difference is that we're probably the only lenders that have been reviewing current financials so that we understand exactly where small businesses fall within the current economic climate and how they compared, for example, in first quarter of 2020 to their first quarter of 2019 numbers and prior. So with that, the next slide. We're going to talk about who's in control of defaults. And I'm going to look to Dawn to start with this because this is certainly where she's expert. She helped create the BRI fund from the ground up and did pretty much everything that you could imagine with that program. So let's start talking about who's in control of defaults, Dawn.
So the word default is usually not a pleasant word, but it can be easily avoided. And it shouldn't be a surprise to you. When you receive a loan or you receive a grant, evidence or events of default are clearly defined in all your documentation, but you have to read your documentation. I was very pleased when the law office started sending out some grant agreements. Initially, the grant was a loan, and then it was converted to a grant later. But when I got questions from recipients who wanted explanation around these events of default, what could cause default, or just had questions about the general use of the funds, those are all great questions. Always, as you're reviewing your documents and you see the word default and you don't understand it, you want to make sure that you get clarity around that, because when you default on a loan, sometimes it's a monetary default. That's usually the most common one. And other times it's a technical default. And both of them could lead to the lender escalating whatever recourses they may have according to the loan documents, depending on how serious the default is. But the most common one is monetary default. And that occurs, of course, when you don't pay the loan as agreed, or you have what's called a rolling lateness. So if you're paying your loan constantly, 30 days behind, and that continues over several months, that's called a rolling 30 days. That also can trigger a default. You maybe think you're keeping up with the payment, but having a rolling 30-day lateness can also be a trigger for a default. Defaulting on a loan drastically reduces your credit score, not just your personal credit score, because many times if you have a loan, you have a personal guarantee, which means it can impact your personal credit, even though you think it's a business loan. Of course, it can affect business credit once you start reporting with that through DNB as well. So you have to make sure that if you're, one of the monetary covenants is that you're paying the loan on time as agreed, not letting it go past 30 days, and really not going past the grace period either, where you start to accumulate late fees, and so that you stay out of that default area. Having default triggers on your loan record will also could inhibit your ability to receive future credit, because lenders will look at the history of other money that's been loaned to you and how you performed with that. And the worst case is a full default can result in the seizure of personal property, business property, and real property, and any assets that are available to the lender by the loan document covenants. Avoiding a default, as we said, is simple. Pay as agreed, right? And if there are any other non-monetary requirements or covenants in the documents, you have to abide by those as well. Remedying the default is just that, either pay or perform. So either make your payments on time or perform as agreed. we can get into, we'll get into a little later what performance looks like. We talked about debt service in those areas, and we'll also talk a little bit later about other things that could be classified as a non-monetary default. These, as I mentioned, that these default events can trigger other things. If you have not just, if you've offered collateral, the lender may decide to seize that collateral. If you have cross-collateralized, that means you have not only offered perhaps the business property, but maybe you offered also your personal residence, or you offered other property you may have. That's called, the lender may have cross-collateralized, or basically they collateralize everything across the board, so that it's not just a loss of one property or one asset, it may be the loss of multiple properties or assets if you default. Grants also have compliance measures. Just because it's a grant doesn't mean there aren't rules and covenants that you have to abide by. As some of you have also received PPP loans and EIDL loans, there are also things that the SBA requires in order for that money to be forgiven. And you really have to make sure you understand that in the documents. And if you don't understand it, you need to contact the lender that provided that PPP loan to you to make sure you understand what's required exactly in order for the loan to be forgiven. Next slide.
So I have 3 things to talk about with regard to that. And some of it's a question for you. So first of all, as an example, with the BRI fund, the way you structured it was that once you accepted a grant, you had to agree to remain in the county, and you had to agree to use county contractors to the extent you had a need for a contractor, correct? So what happened? So if you didn't do it, what would happen?
So there are a couple other things you agreed to. You agreed to use the money in a certain way as well. And you agreed to a public benefit clause of either job retention or job creation as well. And if you don't do those things, the funds could be clawed back. That means you'll have to return the funds to the county for improper use, or not using it in the way that was meant, or not creating the public benefit that was intended. So in the events of default area of your grant agreements, you'll see that there's a public benefit to retain the jobs that you had when you accepted the grant, that you'd use the funds for operating expenses, meaning payroll, mortgage, rent, utilities, debt refi that's associated with the business itself and the operations of the business. So if you instead use the funds, obviously, for personal use or paying off non-related business debt or credit cards, for example, that would be an event of default. You also have to maintain the proper insurances, insurance coverages. Of course, any misrepresentation at all on the application would be an event of default as well under the grant agreement. And please understand that these grants are audited by independent parties. So any misinformation that was provided is going to be cross-checked by the county's independent auditors.
So what happens if you fall out of good standing, and what does that mean to be in good standing with the state of Maryland?
So if you are in good standing, that means you have filed your annual personal property and annual reports with the state and paid your fee. And when you don't do that on an annual basis, then you are not in good standing with the state. And the state reflects that on their Maryland SDAT website, that you're either in or out of good standing. And you do need to remain in good standing during the term of this grant, which is 3 years. And annually, we'll do a periodic check as well to make sure you remain in good standing, to make sure that all your insurance coverages are also current, to make sure that the business is in the stage it needs in order to operate efficiently and to remain in good standing with the state. You don't want these technical kind of things to put your business in jeopardy.
So what if they have a conventional loan and they run into a cash requirement and they go out and get another loan? Could that be a violation of, say, their loan with TD Bank or M&T or some of the other fine lenders in the county?
It could be. Most loan documents have language in there that requires that you get their permission before you take on any subordinate debt or debt that comes behind them or after them. So it could be an event of default as well if you don't get the permission.
Now, you mentioned use of funds. How about use of funds with regard to people that receive Paycheck Protection Program funds or EIDL funds or maybe Maryland COVID-19 funds from the Department of Commerce? They had to be used a certain way also, right? That's a warning.
They did also have to be used a certain way, and most of that was related into payroll and, you know, retaining those employees and keeping them on the payroll or bringing them back on the payroll. So again, I encourage you to look at that documentation very carefully, because the SBA is very specific around that. It was also a timing issue when it comes to forgiveness, as there was a date certain that those employees had to be on and remain on the payroll and for that amount of time in order for the loan to be forgiven. So please check your documents carefully.
All right, so I'm going to jump to the next slide after I say that in most cases, the borrower has the ability to control whether there's an event of default. It's simple. Either you pay or you don't pay on time, or you do or you don't do the things that you're required to do in accordance with the transaction. So that's the biggest tip of the day here, is that you as the borrower have the controls, and you need to understand what your covenants, what you've agreed to. The covenants are, these are the things that the bank is looking at and ensuring that you maintain, which also could include a certain performance requirement for debt service coverage, which we'll get to, debt to equity, and so on. So now, Dawn, what is a covenant?
Covenant is the rules that you have to abide by according to your loan documents. And remember, everyone always thinks about which is the next bullet, the terms of my loan. You know, I'm making a payment, it's at a certain rate, it's for a certain amount of time, that's your term or your amortization, and it's due by a certain date. Those are the general things people think about. But there are other covenants in your loan documents, like you have to provide quarterly or annual financial statements, that you can't fall below a certain debt service. And we'll get to the definition of that shortly. There are performance defaults. And if we go back to providing those annual financial statements, which could be a webinar in itself, that includes an income statement, a balance sheet, and a cash flow statement. That's a complete financial statement for a business. And so we would strongly encourage you to keep up with this, especially if you got to produce them on a quarterly basis, is that you have some kind of accounting software, or you have a bookkeeper, or you have an accountant. Doesn't have to be a CPA necessarily, but someone that's a professional, so that they can keep up with the annual financial statements, or sometimes quarterly financial statements for your business, if you're not able to do it yourself, and do it correctly. Eddie?
Where do I find the terms of my loan?
Where? Well, it could be two places. Your promissory note's going to tell you how much you owe, when you owe it, and for how long. But you could also have a loan agreement that also tells you what all the other rules, and that's usually where the covenants live, where the other events, non-monetary events of default exist, can also exist in your loan agreement.
Perfect. All right, now here comes the advanced section of this meeting for today. This is the part where we hope each of these participants who are online with us this morning really walk away with some serious knowledge. So please take notes as Dawn goes through how does the bank check your debt service coverage and what that means.
So understanding, first of all, what is your debt service coverage? And quite simply, it's a measurement that a company uses to determine their available cash flow after they pay all their current debt obligations, right? So how much money is left after you pay all the bills associated with the business. And so it shows, that coverage ratio shows whether you can do that, whether there's enough income to pay its bills and debts. And then the ratio also tells the lender, is it even? Do you have just enough money to pay for everything and nothing else? Or is there some left over after? And so most lenders will want you to have a 1.25 debt service coverage ratio. That means after you pay 100% of everything that is due, you still have 25% of your income left over to roll to the next month as kind of like a slush fund. You're not just spending every single dime you make after you pay all the bills.
So if you had $100, they want to see you have 125.
Correct.
Okay.
And that your bills only came to 100, not 124, not 125. Your bills, you got $125, your bills came to 100, you have $25 left over to roll to the next month.
But in order to calculate that, you really need to have some financial system to be able to track it. So you need a QuickBooks or something like that to be able to see what your position is so you can navigate as a manager properly of your small business, right?
That's right. Right. And if they were to try to do that, Eddie, what's the math behind calculating debt service coverage? What numbers do they need to look at?
The easiest thing is to look at it from, say, the tax return perspective, okay? So you take the net income number, which is at the bottom and hopefully is positive, and then you have to add back to that 2 different categories of items. The first that you add back are the non-cash items that get deducted from your revenues in order to calculate your taxable income. So for example, amortization and depreciation get added back to that net income number. And then the other thing that would normally get added back are what we in banking call extraordinary items. These are items that only occurred one time and they're never going to occur again in the future. So for example, if in the prior year you had experienced a theft as a result of an employee that pilfered your cash box, or you experienced a lawsuit and you had to pay legal fees, somebody slipped and fell or something along that lines, or something else, those numbers would be added back and you would use that number as what we call free cash flow. That number over your debt service is your debt service coverage ratio. How about debt to equity ratio, Dawn?
Debt to equity, the math of it is your total liabilities divided by your shareholders' equity. So 1-to-1 means creditors and stockholders equally contribute to the assets of the business, right? It's even. Everybody's money is even. A high debt to equity ratio is often associated with high risk. High risk not necessarily means a bad thing. It does mean you've been aggressive in financing the growth of your company with debt, but the end result could be that your earnings are higher, right? So in that case, it's a good thing. But if the business hasn't benefited by that debt, then that ratio could be seen as a bad thing. And it does depend from industry to industry, right? So the main point of this ratio is that the shareholders' equity, right, what they put in can cover all the outstanding debt in the event there's a business downturn, right? And that is where a lot of small businesses are really being hamstringed right now. They're finding themselves over leveraged so that there's not enough equity to cover the debts and the bills that are coming due now, right? I don't want to spill into liquidity, so I'll stop there. You have something to add, Eddie?
But I think in general, you need to look at keeping a debt to equity ratio. You're pressing it at 6-to-1. Once you start to get at 7-to-1, 8-to-1, then I would say in general, because Dawn's right, it varies from industry to industry. Some industries, you just have to have a lot more debt than what others require. So that's it. That's it. I would say that's something to look at as a generic number. And when you look at, how does the bank check my liquidity? Of course, the bank's going to look at your financials. Your financial statements that come in are going to give them the ability to look at where you are. And if they need to do things in an interim basis, they're going to look at your bank accounts. So right now, the one thing I think everybody learned is that cash is truly king. And when we got hit with this unbelievable pandemic, something that most of us have never seen and hopefully we never see again, that in order to get through, the number one pivot, if you will, was how can I cut back expenses as soon as possible, as fast as possible, and what can I do to increase my cash position so that I can get through this, which is exactly what PPP was all about and EIDL was all about. It was to push liquidity into the marketplace to keep small businesses open. And then you saw the government, you saw what Treasury Secretary Mnuchin did with regard to the banks, because there was even a problem with keeping cash in the banks. And if we don't have cash in the banks and we don't have liquidity and people can't use their credit cards, we have this crash, which we end up calling a recession, or even worse, a depression. And that has all kinds of ramifications. So your bank checks your liquidity simply by looking at your bank statements and determining how much money that you have. And they want to see that you've got enough money and what we call working capital to be able to operate your business over so many months, so that it's a safety factor. It's another issue. And now let's talk about something else, Dawn. Let's talk about, if I click over here so we can scroll down, with all this information that the bank's looking for, are they spying on us or what?
It may feel like that, but it's actually not the case. It's really for your own good. Providing, and especially if you're a new business, it may be your first business loan, it may even be your first grant. The lender's going to want to kind of hold you close, right? They may ask for quarterly financial statements. I've even seen monthly for the first 6 months in the case of like the first business loan a business has ever had. And some business owners may feel, look, I'm paying my bill. Why do I need to give you all this financial information every month, every quarter, or every year, as the case may be? It's not because they're spying on you. They genuinely want you to succeed. No lender wants a default, on their books. So by reviewing your financial statements, and that's why it's important that you have some software or a bookkeeper or accountant that can produce these financial statements. When a business has to produce financial statements, it shouldn't be a fury of activity and not knowing what to do. You literally should be able to push a button and they get produced. But you got to have your back office in place to be able to do that. And the reason the lender's asking for it is so that they can help you see some things that could be starting to happen that show up in the numbers that you may not recognize because you're busy doing the business. You're running the business. You're in the day-to-day of it all. And you may not be watching that bottom line number as closely as you should. You may not be watching your debt service coverage ratio. You may not be noticing that certain expenses are increasing exponentially, not like they would in the industry, or not according to your projections that you provided to your lender, or your income isn't growing as you expected. And so it's a way to correct these things, before, they become a big issue. Just like driving, you're constantly just gently nudging your steering wheel a little bit at a time. The car doesn't go straight down the road, even with the greatest alignment, unless you're constantly kind of nudging and massaging your steering wheel. And this is kind of the same way. The lender is just reviewing the financials to see if there's gentle little nudging is needed here and there. They can provide, some advice or a resource where you can get some assistance in that area. We find that, this can be the case with many businesses. And we at FSC First, we try to, provide a resource for technical assistance when we start to see something in financials that start to show up. And it's beyond if they need extensive assistance with readjusting their business, we can refer them to a resource that may specialize in their industry to help them correct those things that we start seeing appear as trends in their financial statements that may catch up with them detrimentally down the road. It may not be a big deal now, but if that number continues to move in the wrong direction, it can become a bigger deal 12 months from now.
You just hit the nail on the head, and you said something I was about to say. So I'm going to add a little different twist to it. I was on the board of FSC First before I became the chief lending officer. And one of the things I was always so proud of is we never just say no. We say no with an explanation. If you could do this, if you could do that, then we could probably help you. And the other thing was, even for the existing portfolio, when someone got in trouble, we always did what we could. I always heard stories of how the lenders at FSC First would provide some sort of suggestion. Here's what we think you could do. Here's a way that you could possibly get out of it, which goes back to two things. One, the current environment that we're in business right now has become very socially conscious. People are thinking about buying local first. People are thinking about doing business with others that are similarly in focus with the environment and taking care of their people and their customers and the planet. I said the environment twice. So I think picking and choosing the right banker who can give you the right kind of advice is also really important. At any given bank, you have different lenders with different expertise. So if you happen to have a restaurant, find the lender that's the lender to that industry. If you have, I know for a fact there are breweries in DC. We don't have a lot of lenders in DC with great brewery experience, but there happens to be a national lender that has amazing brewery experience. And when you show them your budget and your pro forma and the engineer's plans for what they're going to build there, they know exactly, oh yeah, this is really great equipment. We've seen it. This is how the line works. This is how this, yes, this looks like a really good plan that from a facility perspective can be successful or not successful. So when it comes to this concept about spying, borrowers should look at it from the opposite side. I'm actually receiving free consulting advice from a financial services expert that's giving me heads up and early warning. And it's also a lesson that we've taught at FSC First to everybody during this crisis, which is you can't wait with a shoebox full of receipts for all your expenses to go into your accountant's office in March and say, here's all my expenses, please put together my tax return. You really need to have somebody available, either yourself or a bookkeeper or an accounting service that can provide you with regular monthly updates of exactly what your positions are. You need to know exactly what your margins are, what things cost you, what you sell them for, whether there's a profit, whether items are turning, whether you've got inventory that's just completely unusable and you have to discount it to get it out the door so you can put other things on your shelf, whether as a service provider you're providing what's in demand or whether you have to add additional services and pivot and things of that nature. And even, when it comes to expenses, look at what you actually have and whether it's really, really necessary, because building up that cash reserve will be much better for you than not paying the taxes. So many people are worried that at the end of the year, Dawn, we always get these people that have zero net income. Oh, I didn't pay taxes. My accountant's great. He helped me figure out expenses. And they stuck everything, their kid's cell phone from college and, all kinds of expenses that are extraneous, that aren't part of the business. It hurts in two ways. It doesn't make your balance sheet look strong, right? And it also took the value of the business out and put it in your pocket. So if you want to go sell it to somebody else, you already took it. It's already gone. So,
or if you want a loan.
And when you talked, Dawn, you talked about resources. What are some of the resources that people can go to through the SBA and others in Prince George's County to be able to get some additional advice?
Maryland Small Business Development Centers. Go to their website, SBDCMD.org.
And then there's SCORE, which is the Career Retired Executives that's part of SBA, and Lisa Smith at the Bowie BIC.
Yes.
So we have, in Prince George's County, we have a huge number of facilities that can help people. We have one question up, Dawn.
Yep.
I'm in the process of expanding. How does a name change and entity affect my current PPP loan? That's from Renita Flood.
You need to talk with your lender about that name change. In most cases, a clean name change is fine if it's just a name change, and you'll document that with the state if you were formed here in Maryland. But be careful with doing that. Sometimes a name change can be a clean break from an existing performing entity that has a history. So just be careful how you do that, and you really need to consult your loan documents, because that is definitely most likely going to show up in your covenants or things that warrant lender to acknowledge and to accept that you're about to do that. So don't just do it. You need to check with them.
So if there was a name change for just the purposes of marketing, could they do something like a DBA name change and keep the entity and remain in compliance?
As long as the main entity that's on the loan documents remains and they're have a DBA, that's probably going to be okay. But again, you need to let your lender know that.
So how does somebody go about filing for a DBA? And what does that mean?
So are you talking about in relation to how you document this with the lender, or just in general?
Is there a form that I fill out for doing business as, which allows me to have a trade name that's different than my corporate name?
You need to do that with Maryland SStat. There's a trade registration name, because many sole proprietors will do this. They're really doing their tax returns on Schedule C. That's how they're reporting their business, but they have a name that their business goes by. You need to register that with the state as a trade registration.
Beautiful. So now we come to the conclusion and summary. And I think we've said pretty much everything that we intended to say. And I think I'd like to open it up if there's anyone else. I have no questions in the Q&A box. So if anybody else has a question, now's the time to ask. Do you see anything in the chat, Dawn? I don't see anything in
Nope.
Q&A.
There's no questions in the chat or the Q&A.
I don't know if Shelley Gross Wade wants to add a comment here, but she'd be welcome to. She has some great insights for everybody.
Good morning, everyone, and thank you, Eddie and Don, for that sage advice that you've been sharing today. To the participants who are on today and those that will be viewing later, this is just an example of how far-reaching the services are at FSC First. We are more than a lender when it comes to providing access to information for small and minority businesses. And I think the guidance that you've been given today should be valued as information that you would not otherwise have gained access to. This was time well spent for you to dial in and listen to this. So with all of us on the line from FSC First, please do not be shy about asking questions. No question is a silly one. And if you don't ask it, you may be harming yourself or someone else who doesn't have the ability today to ask the question. So one thing I would like to say is all of the advice that was given today, while we frequently referenced it as the bank, it is truly applicable to any lender. And FSC First is a non-bank lender, and your community credit union is a non-bank lender. So we all provide services to help grow and sustain your business. And those services may be different from institution to institution or organization to organization. Most of it is free, as Eddie has mentioned, but be mindful that you have access to very affordable training as well through the Bowie BIC, which stands for the Bowie Business Innovation Center, is housed at the Bowie State University, and the Maryland Small Business Development Center, which we reference as SBDC, that is located at the University of Maryland in College Park. And we also have another resource partner, the Maryland Women's Business Center, which is also located at the Bowie BIC office on campus at Bowie State University. There are a plethora of resources available to you. Most of them are online. Many of them can be accessed through Zoom meetings and things of that nature during this COVID pandemic. Suffice it to say, they're free, so you should take advantage of them as often as you need to. If there are still questions that you have, you can always send those to us at info@fscfirst.com if something comes to mind after you get off the phone. The SCORE representatives can be accessed at the Prince George's County Economic Development Corporation. And I will stop there to see if there are any other questions that you might have.
Thank you, Shelley. Appreciate that. And also, this is a good time for us to say thanks to Pepco Holdings, an Exelon company whose generous contribution supports Emerge Stronger and the work that we do in Prince George's County. Dawn, any final thoughts?
I have nothing else.
So thank you all for attending. My information as well as Dawn's contact information is on your screen right now. Please feel free to reach out to us. We'll get back to you. I want to thank again all the parties that came together to make this a reality. I want to thank Dawn Medley for joining us. I appreciate that, and the comments from Shelley Gross-Wade, our fearless leader. Again, the goal of Emerge Stronger Small Business Recovery and Resilience Program is to increase the post-COVID-19 economic recovery odds of Prince George's County small businesses. We hope that today we've given you some answers and some insights that will help you perform better as small business owners and entrepreneurs, creating and maintaining jobs for those of us in Prince George's County, and recognizing our connectivity and how important we are to each other in this ecosystem we call Prince George's County, our wonderful home. Please come and return next week, October 16th, preparing for financing with Clevin Swat from Clifton Larson. On October 23rd, sources of credit. Dawn will be on that, along with Doug Dillon from Eagle Bank and Akili Eku from AEFC. On October 30th, understanding the lender's language. Very, very important, with one of our board members, Shantan Kittler from Main Street Bank. On November the 6th, contract financing with Anthony Williams from Meridian Management and Anita Graham, who was on with me last week. Many of you saw her from Graham and Associates. And then finally, the last of our campaign will be Pivoting to a New Economy on November 13th. I think many people know about that, but trying to identify new trends and ways to do business. You know, I was at my local pizzeria the other day. They are up 20% over last year simply because they changed their business model. So maybe we can walk through some of those strategies and talk to you all about how we can do that. The idea being that we just want to help you. Robin asked a quick question. Where would we find info on BIC? Look up Bowie BIC, and also look up Women's Development Center in Prince George's County, Maryland. If you can't find either one of them, send me an email, et@fscfirst.com, and I'll get right back to you. I hope everybody has a...
I'm putting them in the chat for them.
It'll be in the chat in a second. We hope everybody has a great weekend. We really thank you for joining us. Stay safe and stay strong.